Hi everybody, welcome to Inspire Investing. Today I wanted to make a video basically explaining the basics, the foundation of stock options. And in order for everybody to advance to those more advanced strategies that everybody wants to get in right away, it's a lot easier to first understand the basics very well, and then those advanced strategies will come to you a lot easier. It's also part of my New Year's resolution to be more active on YouTube. So this is also why I'm doing this. So let's go ahead and jump straight into options. But before then, I want to start with an analogy that might help this transition to some new terminology come a lot easier to you. So I want you to imagine that you bought a movie ticket. Okay, when you buy this movie ticket, it's quite literally giving you the right to go and watch a movie at a certain time and date. Okay, but you're not obligated to do so, right? If you didn't want to go and watch this movie, you don't have to. And you could go and sell your ticket to somebody else for either a higher or lower price, depending on the demand for the movie, right? So imagine you show up to the midnight premiere of Star Wars, right? Let's say this is the midnight premiere of Star Wars. Okay, and you show up to the movie theater and you announce to everybody that you don't want to go and watch this movie and that you're offering your tickets to whoever wants to buy them from you. More likely than not, you would sell these for a profit, right? There's a huge demand for the movie. So again, just think about this ticket giving you the right to go and do something, and that's to be able to go and watch the movie at the certain time and date that it airs. It's also important to note, right, once this movie airs, you cannot use your ticket anymore, right? This ticket is worthless. You can't go and watch a movie that has already aired, right? That wouldn't make any sense. So let's go ahead and transition into the definition of some options. So right here, we just had what we went over. Similarly, with options, you're buying a contract. Okay, options are contracts. And in those contracts, it's giving you the right, or quite literally the option, to buy and sell shares of a company at a certain price by a certain date. So kind of think of this like the movie ticket, right? The movie ticket has that certain date the movie airs that you can go and watch the movie at that certain date. And also it's giving you the right to do something, right? So an option is a contract that's giving you the right to own or sell shares at a certain price. Again, this is called the strike price. If you've ever watched my videos, this strike price is the agreed upon price in that contract. Okay, and if you didn't want to do this, if you don't want to exercise this right, you don't have to. Okay, when you buy an option, you are not obligated to do anything. So buyers of options are not obligated. Okay, and this is something really important to note. You are not obligated to own or sell shares if you don't want to, okay? And if you wanted to go and sell your option, which you can before the expiration, you could sell it for what it's worth. And what it's worth is called the premium. The premium is the price of an option contract. This is what you would pay if you were looking to buy an option contract. Okay, and I want to explain really quickly, there's two main types of options. Okay, there's call options, which I'm going to put over here, and there's put options. And you could, call them calls and you can call them puts. So when you buy a call option, it's a certain option contract, which gives you the right to buy 100 shares of a stock at a certain price by a certain date. Okay, and we'll do a couple examples in further slides. When you buy a put option, you have the option or the right to sell shares at a certain price by a certain date. So call options are giving you the right to buy. Put options are giving you the right to sell. Now, typically, when you buy a call option by itself, you have a bullish bias. And I'll get a little bit further into that. It's a little bit more nuanced than that. But when you buy put option, you typically have a bearish bias. And it can get a lot more complicated, which is why I don't want to overcomplicate things right now. So I'm not going to go too far into that. But let's go ahead and go over some examples. So let's cover the characteristics of an option. Okay, typically when you see something on a trading platform, you'll see these main four characteristics. Okay, you'll see a ticker symbol, the expiration date, the strike price, and the premium, which is again the value of that option contract or how much you pay. So let's start with the ticker symbol, right? I assume most of you watching this video already know what that is. It is an abbreviation for a certain stock, right? The ticker symbol for Apple is AAPL. For Microsoft, it's MSFT. For Walmart, it's WMT, right? They're just abbreviations. And that's telling you the stock, which is the underlying of the option. If you recall, options are derivative securities. So they derive their value from an underlying product. And in this case, it can be Apple, Microsoft, or Walmart. So they're giving you the right to buy or sell shares of these companies right here, whatever this ticker may be. Okay, now let's move on to the expiration date. An option expiration date is the date the option no longer exists. And what I mean is that an option grants you the right to buy or sell shares, right? Well, you only have this right up until what is called the expiration date. And that's what this is right here. And you'll typically see this when you're in your option chain picking a certain contract that you're looking to buy or looking to trade. Okay, now let's move on to the strike price. The strike price is the agreed upon price in the option contract. And so it is the price at which you are looking to buy or sell shares at, that's what's in the option contract. And you'll see right here that we have a call option. Remember, call options are giving you the right to buy 100 shares at the strike price. So we'll cover this entire example in a little bit, but this is giving you the right to buy 100 shares at $80 a share. Some people confuse the strike price with how much the call option or the put option costs, right? This call option is not $80. This call option is giving you the right to buy 100 shares at $80 per share. And lastly, we come to the premium. The premium of the option is how much you pay. It is the price of the option. So if you're looking to buy this call option, you would pay $3.50 in premium. Now it's important to note that options deal with 100 shares, right? It gives you the right to buy 100 shares at a certain price or gives you the right to sell 100 shares at a certain price. So options deal with multiples of 100. So when you see a premium, premiums are priced per share, so you would need to multiply by 100. Okay, and this is already done for you on many platforms. I'm sure many of you who have ever tried to buy an option already know this, but you have to deal with something called the option multiplier. So whenever you see a premium that's $3.50, you're not just paying $3.50, you end up paying $350 for this option contract. Now your premium is still $3.50, but you pay $350. Okay, so if we're wrapping this all up together, this option specifically, you are paying $350 for the right to buy 100 shares of stock XYZ, right? That's our ticker symbol, at $80 per share, which is our strike price or our agreed upon price, by our expiration date, which is July 20th, 2021. Past market close on July 20th, right? This option no longer exists for us, so we no longer have the right to do this. So that's just something important to know. So let's go ahead and go over some examples to help make things a little bit easier to understand. So here we have a Facebook, right? So FB is the ticker symbol for Facebook. October 30th, 2020, $300 call at a premium of $9.45. Okay, so remember the premium is the value of this option. So this is how much you pay as a buyer. How much you pay. Okay, and on most trading platforms, you'll see calls and puts abbreviated with C or P, right? This is C, so it is a call. So this is a Facebook $300 call that has a premium of $9.45 with an expiration of October 30th, 2020. And this example was a little bit further, so this option already expired. But basically what this option is giving you the right to do is to buy 100 shares of Facebook at $300 a share by October 30th, 2020. And for this option, we are paying a premium of $9.45. Now remember, can't forget about the option multiplier. So we're actually paying $945 for the option to buy shares of Facebook at $300 a share by October 30th, 2020. Now let's go ahead and look at this option right here. Okay, this is an Apple put option. We have P for put. Apple, this is the ticker symbol for Apple. And we have a expiration date of December 18th, 2020, a premium of 225. So what this is giving us the option to do is to sell 100 shares of Apple at $150 a share by December 18th, 2020. Again, this option already expired. This is an old example, right? But that expiration date is the day that we no longer have the option to do this. It is the day the option no longer exists. So I want to do an example with a call option, and maybe this can give you an idea of how call options increase in value. So I wanted to say that, let's say we purchased a $100 Facebook weekly call option at a $2 premium when Facebook was trading at $99 per share. Okay, and let's just dissect this, break this down a little bit. $100 would be our strike price. Okay, so remember, this is the agreed upon price in that option contract. This is our strike price. And Facebook, again, FB is the ticker symbol for Facebook. A weekly call option just means that the expiration date is at the end of the week. Okay, and when I just say weeklies, that's what I'm referring to. We have a $2 premium. Again, you have to keep in mind the option multiplier, which we'll talk about in a second, when Facebook is trading at $99 per share. So right here, if we were to go right here, this is where Facebook is currently trading at this red dot right there. So the strike price, again, is the price that we have the right to purchase shares at using this option. And just know that we have to keep in mind with the option multiplier, we're paying $200 for this call option. The premium is $2, but we pay $200 because of the option multiplier. Now, I want you to go to the left of this graph right here. We have our P&L on the vertical axis, and we have our strike or the current stock price on the horizontal axis. Notice that when you buy this option, right, you're down $200 because this is your cost. That is how much you paid. So that is also how much you can lose. Okay, this is our max loss. If things go wrong, right, if this completely turns to hell, we only ever lose $200 because that is the amount we put in. When you buy an option, you have defined risk, okay? When you buy an option, you can only ever lose whatever you put into it, and in this case, $200. So this is our max loss. Now, our break-even price, I want to point this out. Our break-even price is $102. Now, how did I come up with that? Well, this is, you get the strike price, which is $100, and you add the premium. So the premium is $102, right? So our break-even price would be $102. Now, I don't want you to get too confused on this, but the break-even price only applies if you plan on exercising the option, which basically means that if there is, okay, we'll get to intrinsic value in a second, but if you were to exercise your option, you have the right to buy 100 shares of Facebook at $100 a share, right? So that would be at this point right here at $100 a share. But keep in mind that you paid $200 for this option contract. You paid a premium of $2. So in order for you to make up that amount that you originally were down, right? This was your premium right here. This is the amount you were down. In order for you to make that up and not lose money, the stock price would need to be at 102, because if you were to buy 100 shares at $100 a share and the current stock price was at 102, you could sell those shares and make the difference up, covering what you paid for the premium. So that's why it's called the break-even price. But if you're just looking to trade options, if you're just looking to buy a single call or a single put, break-even price doesn't really affect you unless you're only trading at the intrinsic value, which we'll get to that in a second. So in this example, if Facebook is trading at $104 at expiration, right, that would be at this point right here, we stand to make a profit of $300, right? That's right here. And again, this is just an example. They're just made up numbers, but I just wanted to show you that if you were to buy a single call option and the stock price was to rise, all things equal in this example, we would profit, right? When you buy a call option by itself, you have a bullish bias, which basically means you want the stock price to go up. That's just making things very simple. So let's go over a put option example. So let's say, you purchased a 175 American Airlines weekly put option at $3 when American Airlines was trading at $176 a share. So American Airlines would be right here currently. You purchased the 175 strike. Again, this is giving us the right to sell 100 shares of American Airlines at $175 a share. That's what our strike price is. That's the agreed upon price in that contract. Okay. Now, remember, put options give you the right to sell, so you have the right to sell 100 shares. Now, you paid a premium of $3, but remember, can't forget about that option multiplier. So we actually end up paying $300 for this right, or for this option. That means that our max loss is whatever we put into the trade, right? It's $300. So as you see right here on the right of the graph, you're immediately down $300. And notice how the slope right here is completely flat. So this is the max loss. Even if the current stock price were to go up and up and up, you can only ever lose what you put into the trade if you are buying this option. So you have a max loss of $300. Now our break-even price in this example is 172. So we take our strike price and we subtract our premium. So again, 175 minus 3, 172. So the break-even price, again, this should only concern you if you actually plan on exercising your option, is 172. Or if you were to let this expire, but we'll get to expirations in a second. The stock price would need to be 172 in order for you to not lose money. Again, break even means that you're not losing money, you're not making money. But in this case, right, you have the right to sell 100 shares at 175. If the stock price was at 172, you would sell 100 shares here, and you would be able to buy them back at 172 and keep the difference, which would make up for whatever you paid for in the premium. Now, in this example, if American Airlines was trading at 169, right, if the price dropped, you would stand to make a profit of $400 if you were to sell this option. Okay, and again, you can sell options, you can buy them, you can sell them. When I mean sell in this example, it just means selling something you already own. Okay, I'm not talking about shorting, but basically if you buy a put option, you can sell it before expiration. In this case, because the price dropped, which is something I really want you to understand, the value of this option increased. Okay, with call options, price goes up, all things equal, that call option will increase in value. With an put option, it's the opposite. Price goes down, all things equal, that the value of that option, or its premium, will increase in value, and now you could sell it for a profit. Again, this is very simplified, but I just want to make this a little bit more clear to people. So now I want to talk about option moneyness. And this is something very important to understand, as it has a relationship with the option Greeks, which we'll get to in part 2 of this video. But basically what option moneyness is referring to is the relationship between the option strike price, again, that's an agreed upon price that we've talked about, and the underlying stock price. And so you'll see that, if you've heard people talk about options before, they might have referred to some as in the money, at the money, or out the money, which is all abbreviated right here at the top, which we'll explain in depth. So first, I'm going to throw up a couple definitions or just relationships on here. You don't have to memorize them. I don't want you to have to memorize them. And I'll just put up a couple graphics in the next slide that, will help this tie together a little bit better. But with call option moneyness, in the money refers to when the strike price, or the price that you have the right to buy at, is below the current stock price. At the money is the easiest one. It is when they're both equal, and the out the money is when the strike price, or that price that you have the right to buy shares at, is above the stock price. That is out the money. Now with put options, it's sort of flipped. Okay, in the money would be when the strike price, remember with put options, the strike price is showing us the price at which we have the option to sell 100 shares at, would be above the current stock price. At the money is equal, out the money is when it's below. Okay, and I don't want you to have to memorize this. You can screenshot it if you want, but I'm going to go ahead and move on to the next slide, which will help things tie together a lot better. So right here we have call options. Again, think about call options. I want you to start thinking about them as when you buy a call option, you want the price to go up. And that's very, making things very simple, but I just want you to think about that when we're thinking about moneyness. Okay, and so right here we have a graphic. On the left, we have an in the money call option, which means that the strike price is below the stock price. Okay, and at the money would be when they're both equal. Out the money would be when the strike price is above the stock price. Now, if you think about the direction, right, we're going up. The stock price is already past the strike price. At the money is when it's equal. Out the money is when the stock price is below or hasn't reached the strike price yet. Now, I really want you to think about the definitions and sort of the fundamentals behind this. Remember, a call option is giving you the option to buy 100 shares at the strike price. Now, which one would you rather do out of the three, right? Would you rather buy 100 shares at a cheaper price than the current stock price, right? Which would be in the money. At the money would be when they're both equal, or out the money, would you rather pay a higher price for those 100 shares than the current stock price, right? Easily, it would be the in the money option, right? With the in the money option, we have the right to do something that is actually desirable. This option has real value, okay? In the money options have real value in the sense that they allow you to do something that is desirable, right? You are buying 100 shares at a cheaper price than the stock price. At the money is when they're equal. Out the money doesn't make sense to actually exercise, right? If you were to exercise an out the money call option, you would purchase 100 shares at a higher price than the current stock price, right? Why wouldn't you just pay for the current stock price? Doesn't make sense to exercise this out the money option. You would lose money. Okay, so out the money options don't have real value. No real value, which I'll explain in a second when we get to intrinsic value, but they have no real value. They have something called extrinsic value, which we'll get to in a second. So let's talk about put options now, okay? With put options, you have your in the money, at the money, out the money again, but this time it's kind of flipped. Now, notice how this arrow right here, we're going down now because all things equal, right? Just that example we're looking at, price went down, our put options went up in value. And that's what we want. We want the price to fall if you buy a put option. You have a bearish bias. And so that's going to increase in value and you could sell it for a profit potentially. In this example, in the money, right? We see our strike price is above the stock price. In this case, we have the right to sell 100 shares at the strike price, right? Above the current stock price. At the money is when they're both equal. Again, easiest one to remember. Out the money is when the strike price is below the current stock price. Now, again, I want you to think about this fundamentally. Think about the definitions. Would you rather sell 100 shares at a higher price than the current stock price, at the same price as the stock price, or at a cheaper price than the stock price, right? Right off the bat, it's very obvious that you would rather sell shares at a higher price because you are getting more money, right? You're selling at a higher price, you're going to receive more credit than if you were to sell at the current stock price, right? This is desirable. The in the money option is desirable. Out the money, you'd be selling at a cheaper price, a discounted price. Why would you want to do that? So let's go ahead and do an example. Right here on the screen, I have the Robinhood platform. I have Uber call options on the screen right now. Now, I don't recommend using Robinhood to trade, but if it works for you, it works for you. The only reason I'm using it is because it has a simple interface and I want to get my point across. So let's go over what in the money and out the money looks like on this trading platform. So right away, you see that the share price is at 34.68. Okay, that's what Uber is currently trading at. Now up here we have our option expiration date. We've talked about that already. These options expire on September 11th. And we have call options and we're on the buy side. So again, when you buy an option, you are not obligated to do anything if you don't want to, right? Buyers have the option to buy shares. So that's important to note. On the left right here, you have our strike prices, which again, that's your agreed upon price. That's the price that you are allowed to buy shares at, 100 shares of Uber by the expiration date, right? So let's go ahead and dive right into this. Right here, we have a strike price of 34.5, 34, 33.5, and so on. Notice how all four of these option contracts are below the current share price, right? The current share price is at 34.68, 34.50, 34, and so on is all below this current share price. This is allowing you to buy, or these options right here are allowing you to buy 100 shares of Uber at a discounted price, right? 34.50 is below 34.68, which is the market price, which means that you have the right to buy shares at a cheaper price. So again, that has real value. We've talked about this. All of these have real value. Okay, and when I mean real value, I'm not talking about is that have a premium or if they don't have a premium, right? All these options have premiums, but this premium has real value priced into it. And I'll talk about that in a second, but right here you see that all of these options are giving you the right to do this at a cheaper price. So these options are in the money. Again, if you wanted another way to remember that, is that just think about it. All the strike prices below the current share price for call options are in the money, okay? Now, then we look at these strike prices up here, right? 35, 35.5, and so on. All of these are above the current share price. So when you look at that, right, these options, these rows right here are giving you the right to buy shares at a higher price than the current share price, right? That doesn't make sense. Why would you want to buy 100 shares at a higher price when you could just get it at the market price, right? And so these options don't have real value, okay? And so they would be out the money, but they don't have real value. And I'm not saying they don't have premiums, right? We'll talk about how those are priced, but they still have premiums. They still have value. They just have no real value, no intrinsic value because they're not below the share price. So let's go ahead and move on to another example. Right here we have Uber put options, okay? And so when we're looking at Uber put options, all right, let me go ahead and take that away really quick. You guys already saw that, but basically you have the right to sell 100 shares at the strike price, right? That's our agreed upon price. Now right here you see strike price 35, 35.5, and so on. So you have the right to sell 100 shares of Uber at 35, 35.5, 36, which is all above the current share price, right? The current share price is 34.58. So you have the right to sell at a higher price. That is desirable. That has real value. Okay, and so these options, you've already seen that, was in the money. These options are in the money. Now, the ones that are out the money are the ones that the share price has yet to drop to. Okay, if we think about it, these options, 34.5, 34, are all below the share price. So you have the right to sell 100 shares at these prices down here. Now, why would you want to sell shares at a discounted price, right? While you could just sell them at the market price and get more money. So these right here are out the money. Again, you want to think about it another way. The in the money put options are the ones above with the strike prices above the share price. Out the money is the ones below, the ones where the share price is yet to drop to. Okay, so that's one way to remember it. But just know the ones in the money have real value. The ones out the money have no real value. And again, real value, I'm referring to intrinsic value, and I'll explain that more in later slides. So again, right here we have another example. This is Microsoft. This is on the Thinkorswim platform on an iPad. So it is the mobile Thinkorswim platform. On the left side, we have call options, right? On the right side, we have put options. And so down the middle, you see the strike prices, and you see each row represents a different option contract. Okay, right here we have our current share price, which is 226.58. Again, think about what is more desirable? And right now we're looking at call options. So would you rather buy 100 shares of Microsoft at 225, 222.5, and so on, or would you rather buy them at 227.5, 230, and so on, right? You'd rather buy it at those cheaper prices because those are below the share price. That's desirable. That has real value. And so that would be in the money, okay? And the put options is the opposite. You have the right to sell 100 shares. Would you rather sell at these higher prices right here, or would you rather sell at a cheaper price than the market price? Right? That isn't desirable, so you'd want to sell at a higher price. So these options right here are in the money, and Thinkorswim does a good job. It highlights them, highlights the in the money options blue, the out the money options black. Again, just think about what an option is giving you the right to do, and you can figure this out on your own, right? If you're still confused, call options give you the right to buy 100 shares. Would you rather buy 100 shares above or below the share price, right? If it's below, that's in the money. If it's above, it's out the money. Put options, you have the right to sell. If it's above, that's in the money. If it's below, that's out the money, right? Just think about those things, and it really doesn't get too complicated. Again, it just comes with some practice, and you got it. So why does option moneyness even matter? I've just talked so much about option moneyness, about in the money, at the money, out the money, how to identify those, but why does it even matter in the first place? But before we understand this, we need to know how option premiums or the value of options are actually priced. And I know I could get into a lot more pricing models and make this a lot more complex than it is already, but let's just keep it simple, okay? Option premiums are composed of two main components, okay? You have intrinsic value and you have extrinsic value. Now, we've already talked about intrinsic value. This is that real value that I was talking about, right? The ones with the in the money call options, in the money put options, those have real value because they're allowing you to buy at a discounted price or sell at a higher price than the current market price, right? That is the real value, and that's what I was referring to. Extrinsic value, we have not talked about yet. Extrinsic value comes from time till expiration and volatility, okay? And these two things, volatility, can I spell that right? Cool. Time till expiration and volatility. Now, those things are what's allowing those out the money options to have value. That's why they have premiums, right? They have time till expiration and also volatility. So intrinsic value is the amount by which the strike price is in the money, right? We've talked about this. With call options, it's the amount it is below the share price, which you'll see right here. Right, intrinsic value for calls is the stock price minus the strike price. Now we've shown this, and I'll show a graphic on the next slide, but it's the amount that the strike price is in the money. It's, remember, allowing you to buy it at a discounted price below the current market price. So that's how you calculate the intrinsic value for call options. For put options, the put option strike price would be above the stock price. So if you take the difference between the two, you have the real value of the put options, the intrinsic value. So let's just do an example. If Apple is currently trading at $500, and let's say you purchase the $490 call option, right? You would have an intrinsic value of $10, right? Because you have the current stock price minus the strike price, $490. It's giving you the option to buy 100 shares of Apple at $490, right? Which is $10 below the stock price. So that is your intrinsic value. Now, intrinsic value only applies to in the money options just by definition, right? It's the amount the strike price is in the money, so only in the money options can have expiration. It's also important because this is the real value of the option. It is not affected by time decay, and so that is just something really, really important to understand as option traders. So the intrinsic or the real value of options is not lost to time decay, which we will get to in the next slide. And we'll get to this when we talk about theta and the other option Greeks, but let's just go ahead and explain this a little bit further. So right here we have the same graphic we had when we were explaining the option moneyness part. Now I want to explain it using the intrinsic value, right? Remember, only in the money options have intrinsic value. Right here you're looking at call options, and so the difference between the stock price and the strike price would be the intrinsic value of that option. Right? And likewise with a put option, again, only the in the money put options have intrinsic or real value. So the difference between the strike price and the stock price would be. So let's talk a little bit about option parity and expiration dates. Okay, I talked a little bit about time decay, how that affects the option premium, but I didn't go too in depth with it. So options are depreciating or wasting assets. And what I mean by that is that their value decreases as time progresses, okay? As you get closer and closer to the option's expiration date, its value is going to decrease, all things equal. And that's really important to note, right? When we're talking about Greeks, when we're talking a lot of things about how options are priced, it is all theoretical. It's assuming that things are being held constant, which in course in the real market it's not always like that, and so we have to take this into consideration. But all things equal, or all things held constant, their value decreases as you get closer and closer to that expiration date, and that's known as time decay. And so at expiration, what happens is that all option contracts expire at their intrinsic value. Okay, and that is, again, that real value we were talking about. Again, that is only in the money options, right? Only in the money options have that intrinsic value. So this means that the in the money options expire purely at their intrinsic value. Now, when they're trading at their intrinsic value, when they're priced at their intrinsic value, this is called option parity. Okay, and so when someone says their option or call option is trading at its parity, it's trading at its intrinsic value. And you'll see this, when you're very, very close to that expiration date, you'll most likely see that an option has already reached its intrinsic value. So by the time that expiration date is reached, right, and the option expires, it expires at the intrinsic value, right? That is the real value. And that happens because of time decay. Now, at the money or out the money options don't have intrinsic value, right? Remember, this intrinsic value is the amount the strike price is in the money, right? That wouldn't make sense for an at the money or out the money option to be in the money. That's why they're called out the money and at the money. So they will expire at their intrinsic value, which is nothing, right? So they will expire worthless. And so lots of people don't understand this, and I see lots of people trying to buy super far out the money call options or super far out the money put options, and they don't realize that these options have a super high probability of expiring worthless because they're going to expire out the money and not have any real value in them, right? They're not buying real value in those premiums. So this is again something to understand. So let's go ahead and wrap things up with a little bit about time value, okay? Again, remember that option premiums are composed of intrinsic value and extrinsic value. The intrinsic value being that real value, I'll just abbreviate it with RV, extrinsic value composed of time till expiration, to expiration, and volatility, okay? Volatility. Oh my gosh, I can't spell. Okay, so intrinsic value and extrinsic value. Now, recall that only in the money options have intrinsic value, right? Intrinsic value is that real value, and only in the money options have that because they're giving you the right to buy shares at a cheaper price than the current market price or sell at a higher price, right? That's why they have real value. And only in the money options have those. So that means that those out the money options are completely made of intrinsic value. So their premium is 100% extrinsic value. If you take this equation up here, right, the intrinsic value and the extrinsic value, and out the money options don't have that extrinsic value, right, you're not going to have the intrinsic value component, so you only have the extrinsic value in your premium. And so this means that out the money options are completely exposed to time decay. What I mean by that is that they're going to be worthless at expiration. So let's go ahead and show a few graphics here on the screen. Right here you have the premium of an in-the-money option. Okay, so this entire bar represents the premium of an in-the-money option. So you have that real value component, which is the intrinsic value, and you have the extrinsic value from time till expiration, and volatility, right? So I'm just going to label that vol. So time to expiration and volatility. Now, if you used to remove this intrinsic value, you'd be left with an out the money option, right? So out the money options are completely made of extrinsic value. Now, this yellow bar is affected by time decay. Intrinsic value is not affected by time decay. The yellow bar is. So as time progresses, this is going to go further down, decreasing. And so is this yellow bar right here. So that at expiration, you are going to expire at an intrinsic value. Now, this call options, in-the-money call option, or this in-the-money option, has intrinsic value. So the extrinsic value is going to be completely gone at expiration, and so is all of this. So that sort of goes to show you how those out-the-money options are going to be at 0 at expiration. The in-the-money options are going to be at their intrinsic value. So this is part of a larger series of videos. Next video, I'm going to explain the option Greeks and how those measure your risk exposure in the market. Also choosing the right strike prices and also using the Greeks to help figure that out as well. But I hoped you learned something and I hoped you really enjoyed this video. If you have any questions, feel free to drop them in the comments below or message me on Instagram, on Discord, anything like that. If you wanted to trade with me live as well, I do run a Discord. I have a free Discord and a paid Discord, and so I'll drop those both in the description below. But I hope everyone enjoyed this video, and I'll see you in the next video.